Thomas, thank you very much for joining me today. How are you doing?
I'm very well, thank you. It's great to be here.
Fantastic. So we wanted to talk to you about the impact of COVID-19 on models in financial services. Tell me more about this.
Sure. And I mean, first and foremost, it's clearly a catastrophe for lives and livelihoods. And of course, the impact on models is somewhat secondary. But focusing in on this for now, there's been a very wide range of effects. And a lot of this has come from data time series, which have suffered big discontinuities as everything has changed. So the rules of the game have changed. We've got employee support schemes, we've got new types of subsidized lending, we've got massive changes in individual behavior. And it's affected different models right across financial services. So an obvious example is credit risk. And it's a little bit hard to know how that's going to play out as people's behavior changes and jobs are a little uncertain. But then you've got some other less obvious examples: financial crime and operational risk. The sudden switch to working from home, maybe reduced oversight and controls. There's the potential for increases in cyber events and fraud and other related things. And then lastly, if you take insurance, there's huge changes in behavior of individuals here and changes in the exposure to risk. And that includes some counterintuitive trends emerging, such as lower claim frequency for motor insurance, but higher severity as people are driving less, but when they do, the roads are clear and they drive fast.
What has this experience taught us and you about the more advanced approaches that are available today, like machine learning?
Yeah, I mean, it's an interesting question because some people think of machine learning as almost being the answer to everything. But actually, even the most advanced approaches rely on data fundamentally. And one of the big challenges with the current situation is the discontinuities it's created in the data. Even the best models are affected by this. And in some cases, machine learning might make this worse as the reliance on data is actually stronger. So in some ways, it's actually a good demonstration of how models need to be chosen appropriately for the situation. And situations like this where we don't have much history, or maybe the history is very distorted, but we can make assumptions about what's going to happen in the future judgmentally. Sometimes that expert judgment is going to be the right solution.
Has firms' way of thinking about model risk management changed as a result, and how?
Well, historically, model risk management has been a little bit more backward looking, and it's about handling things that have come before, checking whether performance is normal in comparison with what we've seen in the past. But COVID clearly is an example of this sort of eponymous black swan event. And in this case, model risk management has actually been about responding to the crisis rather than preventing it from happening in the first place. And we've talked to a lot of firms and we've seen how this has played out. And in many firms, the risk team was actively helping the first line model developers to triage models, identify those most likely to be affected, and prioritize their mitigation measures. And then even now, as things become more stable, model risk teams are helping to determine the best long-term strategy and replacing some of the quick fix overlays and adjustments with more robust solutions.
So it's a very busy time for model risk managers. But since you mentioned Black Swan event, what do you think will happen when another one of these occur?
Yeah, well, that's a good question. I mean, we need to be prepared for the next Black Swan, not just building defenses against what's come before. And I think one of the biggest challenges with this is we don't know what the next Black Swan will be by definition. So one of the things that came out of the many discussions we've had with model risk managers across the globe in our series of roundtables is the need for a crisis toolkit, or even better than that, having models and governance that actually help ensure stability in times of crisis. So we're increasingly seeing models that incorporate ongoing monitoring and approaches that track how the model is behaving and can alert users if there are issues. And as this gets more sophisticated, models can become much more defensive and potentially handle unusual situations better or more safely. And this is in some ways a bit of an evolution of things we've seen in specific pockets of industry. So for example, in algorithmic trading, you have the concept of kill switches to prevent the models from doing too much damage if something isn't working the way it was intended. So fundamentally here, what we're seeing is implementing these sorts of principles. And it's really a shift from risk management through to resilience.
So Tom, how should firms be thinking about building resilience from now on?
Well, I mean, even coming right back to today, the fundamentals of good model risk management are a great starting point. And then as firms get more sophisticated with this, they introduce more monitoring and develop ecosystems of defensive models. We should see greater robustness as well as lower costs of owning and running advanced analytics. So ultimately, we expect to see firms moving towards risk management being incorporated directly into the fabric of models and the model lifecycle, with model developers and model risk managers working side by side. And this is a concept we've previously written about and have called de-risking by design.
Thomas, thank you so much for joining me today and for sharing your thoughts on model risk management today.
Thank you very much. It was really great speaking to you.